Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 83, we're going to look at some of the basics of spousal lifetime access trusts, also known shorthand as the SLAT. This is a timely discussion as we're in a period of uncertainty, I guess you can say, with respect to the gift tax applicable credit. Some of that uncertainty has been reduced now that we might know the results of the election, at least in part, but there's still a lot of fear out there that down the road the estate tax applicable exclusion amount could be reduced, and if that were to happen, it could be lost forever. So a good strategy to use that is a gift to a trust such as the Spousal Lifetime Access Trust. Now, as always, this presentation is not intended to substitute for legal or tax advice. So, just to refresh you on gifting strategies, there's a couple reasons to gift for gift and estate tax purposes. One is, with gifting, you freeze the value of gifted assets for gift and estate tax purposes because the asset is ultimately included in the calculation of estate tax, but it's included at its date of gift value as an adjusted taxable gift. Now, this goal is sacrificed if assets are subsequently included in the gross estate due to the donor's retained possession, enjoyment, control, or reversion, or the right to amend or revoke, any of those types of things. So because of that, you can't necessarily gift away assets with the hope of getting them back if your economic circumstances change. That's one of the biggest pitfalls with gifting for transfer tax purposes, is that it's a permanent strategy that often keeps you from accessing the gifted assets unless you use a retained interest trust like we looked at before, like a GRAT or a QPERT or something like that. Now, there's also an added goal that we've talked about in previous episodes where if the exclusion amount does go down, there is an estate tax anti-clawback credit that says if you use up some of that exclusion, which is currently $11.58 million on taxable gifts, and it goes down to an amount under what the available exclusion is at the time of your death, you can get a credit for the difference. So a lot of people are gifting to use this exemption, and with this credit, you're not necessarily as worried about whether assets are included in the gross estate, because even if they are, it creates a tax-neutral transfer that really kind of mirrors what would have happened if you had died holding those assets with an $11.58 million exclusion. But it's important to note, too, that this credit and the regulations that kind of refine this credit don't necessarily address any sort of anti-abuse provision, but there is the added risk hanging out there that a transfer that is intended to get pulled back into the gross estate could be deemed to be abusive by the IRS, so that this credit could be denied. So a good example of that could be like a grantor retained income trust that's not in a form specifically condoned by the IRS. So, with these gifting strategies, you often find yourself gifting permanently, maybe to a spouse or maybe to children and descendants. Now, with spousal gifts, one problem is that they're often designed to qualify for the marital deduction. If you make an outright transfer, it's going to automatically qualify for the marital deduction, and there will be no gift tax applicable credit used, which reduces the ability to get that credit. And the cost is that this really just defers estate tax because the asset will ultimately be included in the donee spouse's gross estate, and you could end up wasting some of your estate tax exclusion there. And you also have the economic risk where a spousal gift carries the risk of divorce because you couldn't necessarily get that asset back, or the risk of the donee spouse predeceasing the donor spouse, which is a big deal if there's a gift in trust because that asset couldn't necessarily be accessed by the donor spouse, as we're about to see if you want to achieve maximum estate tax savings. You You could also make gifts to children, maybe in trust, but because dominion and control of the gifted assets must be released in order to freeze that transfer tax value and use your applicable credit, then you cannot access those assets either during your life, and you can't necessarily have the right to access them at death, again because of that estate tax issue. So one way to kind of combine these two worlds and these two risks and reduce some of these issues, but not necessarily eliminate them, is through the use of a Spousal Lifetime Access Trust, or a SLAT. Now, the SLAT is not just a wallboard like it sounds like. Instead, it's an irrevocable trust that's set up to benefit both spouse and descendants. Now, the biggest issue with SLATs or any transfers right now that a lot of clients are concerned with is access to the gifted assets. Now, it's very, very hard to achieve that outside of a retained interest trust like we've looked at in previous discussions. But the SLAT is set up in a way where maybe there could be access in the future, and we'll talk about that in a bit. But for the time being, the basic structure is that you have an irrevocable trust that is designed in a way that it won't qualify for the gift tax marital deduction. And because it's set up that way, it means that you'll use the grantor's applicable credit before it is used up. And with this type of a trust, the spouse and children can receive distributions of income and principal in the trustee's discretion. Now, if you have the spouse as a trustee, remember the goal is not to have the assets included in the spouse's gross estate. So if you have a spouse as trustee, you should make sure their right to make distributions to themselves are limited by an ascertainable standard such as health, education, maintenance, and support, or you could also have the $5,000 or if greater 5% limitation on annual distributions in order to avoid that estate inclusion. Now, the biggest question outside of transfer tax that a client is really concerned about is, can the grantor of the trust benefit from the SLAT? Now, the grantor themselves cannot be a beneficiary, otherwise you have a 2036 or 2038 issue like we looked at earlier. But it's assumed that as a natural byproduct of the marital relationship that there could be some incidental benefit that passes to the grantor's spouse. And up to now, the IRS has not necessarily attacked this type of a transfer as being abusive for gift or estate tax purposes, or as being a transfer that has retained possession, enjoyment, or control. So, one piece of this is that some of the spouse's needs, if satisfied from the trust, could indirectly fulfill the grantor's needs as well, such as paying bills on the house and, buying food, taking trips, things of that nature. All this depends on the distribution standards and how broad or narrow they are. And if you have residential real estate in the trust, it could potentially be used by the grantor's spouse as a guest of the beneficiary's spouse, but that could be risky, especially with a personal residence. It may not be as risky with a vacation home. But the big picture here is that there's no black and white rule here, other than the recommendation that there be no prearranged deal for the grantor to regain possession, enjoyment, or control. So there's a lot of ways this could be looked at and a lot of strategies to create access to the assets. And that's a subject for another time, to look at things like loan powers, powers of appointment, things of that nature, which are risky and don't necessarily guarantee that the tax benefits will be achieved, but are more backdoor strategies that are intended to ignore transfer tax goals if the grantor gets into an emergency. Now, one big pitfall with this is the grantor trust status. So, with many irrevocable trusts, they can be set up as a grantor trust easily by giving the grantor some sort of administrative power that doesn't rise to the level of possession, enjoyment, or control, such as the right to substitute assets of equivalent value. And then if you want the trust to be a non-grantor trust and pay its own income tax in the future, the grantor could simply release that power. However, in the case of a SLAT, that ability is lost. It's not as easy to toggle back and forth, mainly because even if that power is released, the fact that income can be distributed to or accrued for the benefit of the spouse will cause the SLAT to be a grantor trust, notwithstanding the release of that power. Another common pitfall would be if the SLAT owns life insurance on the life of the grantor or the grantor's spouse, payment of premiums on that life insurance from the income would also make it a grantor trust. So, Why might you want a non-grantor trust? Well, there's a variety of reasons. One would be if you want to avoid state income tax, if you have a trust administered in a state that doesn't have an income tax. Another reason could be for some sort of gain exclusion, such as the gain for qualified small business stock under Code Section 1202. Another common reason might be to avoid income tax reporting, maybe in a post-divorce or post-judgment type of situation where you just don't want that income of the trust, especially in a huge liquidity event, reported on your personal income tax return. But once again, that's a discussion for another time. We'll have some follow-up episodes dealing with the access issue and the non-grantor trust issue. But in the meantime, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.